Glass bursts, a sharp crack slicing through the tension. Shouts echo off the marble walls as flashbulbs strobe like lightning. The Treasury Secretary storms out of a closed-door press briefing, his tie crooked, papers clenched in one hand, and his face just flushed with frustration. Scott Bessant isn't walking. He's charging down the corridor, trailed by a storm of cameras. As he passes, one reporter catches a brief, 5-word statement. "We sent the letters. 100. And just like that, the Capitol falls silent. Behind those words lies a diplomatic shockwave. 100 countries received what Bessant calls tariff letters. But his critics say they weren't letters at all. They were ultimatums. No negotiation, no dialogue. Just a printed warning. Renegotiate trade under U.S. terms or face tariff rates not seen since the 1930s. According to Bessant's office, some of those tariffs could surge to nearly 50%. The problem? Many of those nations never agreed to open trade talks in the first place. Vietnam, South Korea, and Mexico may rely heavily on U.S. exports, but others, from Chile to Indonesia to Turkey, have stayed completely silent. No statements, no calls to Washington, no public reaction. That silence isn't confusion, it's calculation. It signals one of two things. Either they don't believe Washington will follow through, or they've already built stronger trade bridges elsewhere. And that silence has weight. Bloomberg's Global Trade Tracker reports that more than 60 of the targeted countries now conduct more annual trade with China or India than with the United States. That's not ideology, it's math. Global supply chains have shifted. So why would these nations accept one-sided terms when they already enjoy smoother, lower tariff corridors through BRICS and other regional blocs? What looks like resistance may actually be indifference, a quiet acknowledgement that the world's economic center of gravity is moving east. But the real shock came with the timing. The tariff rollout has already been delayed 3 times, first July 7th, then August 1st, and now indefinitely. Bessant insists this isn't retreat but signal, yet investors aren't convinced. The moment his remarks hit the Bloomberg terminal, the S&P 500 plunged 2.1% intraday. Not because of the tariffs themselves, but because of the chaos surrounding them. Just weeks earlier, Congress had approved a $3.4 trillion tax expansion, one that economists warned could ignite debt-driven inflation. Add tariff uncertainty to that mix, and Wall Street sees a perfect storm. There's no clear policy line anymore, only scattered warnings, shifting deadlines, and trade partners who no longer pick up the phone. Meanwhile, another front opens, one even more unpredictable. Under the administration's new directive, any nation seen as aligning with anti-American BRICS policy faces an automatic 10% penalty tariff. The catch? The phrase anti-American isn't defined. What counts as anti-American? De-dollarization? Joint infrastructure with China? Multilateral payment systems that bypass SWIFT? Under such vague criteria, even allies could be caught in the net. Germany, for example, could face penalties simply for settling energy imports with China in renminbi. Brazil might be hit twice over for participating in the BRICS Reserve Asset Program, a framework still on paper, designed to enable trade in oil, lithium, or grain using a shared non-dollar instrument. Washington is already drawing red lines around an institution that doesn't yet exist. This isn't diplomacy, it's a moving target, one painted on the backs of anyone trading outside the dollar system. And therein lies the deeper irony. The United States is now weaponizing the very global trade architecture it created. The WTO, the IMF, SWIFT, all were built on American leadership. For decades, Washington wrote the rules, funded the mechanisms, and enforced the norms of free trade. Now, as BRICS evolves into a parallel economic bloc, emphasizing local currencies and commodity-based trade, the same system is being used to isolate its architect. Interdependence, once America's greatest strength, has become its limitation. Look closely, and Bessant's so-called trade strategy begins to resemble something else entirely. Less diplomacy, more containment. A doctrine without borders. A plan not to engage, but to corner. It's a shotgun negotiation with no willing partner. A race against a clock that keeps ticking louder. The numbers tell the story. In the year 2000, G7 economies accounted for nearly 70% of global GDP. Today, they make up less than 43%. BRICS nations, once a minor player at 18%, now represent about 34%. And the gap is closing fast. The IMF projects that by 2029, China alone could represent 19% of total global output. And that's before expansion. If pending members like Indonesia, Egypt, and Saudi Arabia join by 2026, BRICS could control nearly half of the world's productive capacity, and over 50% of its critical mineral output, lithium, cobalt, nickel, and rare earths. In that reality, what leverage does a tariff threat really hold? Washington still insists its massive consumer market gives it unmatched power. But leverage, as every economist knows, cuts both ways. The United States imports more than $3.1 trillion in goods annually. China remains the top supplier for electronics, batteries, pharmaceuticals, and auto components, all essential to American manufacturing. Tariffs might wound foreign exporters, but U.S. producers will bleed too, through higher input costs, supply disruptions, and inevitable retaliation. In the end, this isn't just a trade dispute. It's a mirror, reflecting a new economic order where influence is no longer dictated by market size, but by who controls the supply chains of the future. And for now, Washington's threats may sound loud, but the silence coming from the rest of the world might be saying even more. Retaliation isn't a warning on the horizon. It's already happening. In 2024 alone, China's total BRICS trade reached 4.6 trillion yuan, about 650 billion US dollars, a 5.2% year-on-year increase according to China's Ministry of Commerce. And that growth came despite a European recession, US rate hikes, and global demand slowdowns. So imagine what even a modest realignment could do under the weight of penalty tariffs. With a single executive order, the U.S. could end up pushing its own allies to reroute supply chains toward BRICS economies, a shift that, once made, won't easily reverse. In fact, it's already happening. Reuters reports that since 2023, more than 37 countries have formalized renminbi settlement systems, allowing direct trade with China in their local currencies. The Gulf Cooperation Council has begun UAE-based crude contracts, and both Brazil and Argentina now settle over 40% of their trade with China outside the US dollar. This isn't speculation anymore, it's execution in motion. The ripple effect is clear. As more trade bypasses the dollar, demand for U.S. treasuries weakens. Bloomberg data shows that foreign purchases of U.S. government bonds have fallen by nearly $289 billion over the past year, the sharpest decline since 2016. The biggest sellers? BRICS nations and their closest partners. China's holdings alone dropped by $12 billion, its fastest drawdown in almost a decade. The logic is simple. Less trade in dollars means fewer dollars to recycle into U.S. debt. That collapse in demand drives U.S. borrowing costs higher, a dynamic analysts have started calling Bessant's Boomerang effect. But China isn't just selling treasuries, it's buying gold. The People's Bank of China added 70,000 troy ounces in June, bringing its 8-month total to over 34 metric tons, according to official data. This isn't about chasing yield. It's about building resilience. Gold carries no political risk, no sanctions exposure, no U.S. debt drama. And that's exactly why it's becoming BRICS' preferred safety net. The irony is thick. A metal once demonetized by Washington is now the very asset being weaponized by Beijing. Even Europe is making quiet but telling moves. In a rare shift, a German church pension fund recently invested $50 million in a Hong Kong-based Chinese equity fund. The Financial Times reported the move as a hunt for high-growth, undervalued industrial and tech exposure, but symbolically, it's enormous. A NATO-aligned institution channeling capital into markets, Washington increasingly labels adversarial. While Bessant debates tariff triggers, BRICS is quietly absorbing Western investment. Markets have noticed. Year-to-date, the Hang Seng Index has surged over 21%, while the S&P 500 trails below 7. Wall Street isn't collapsing, but global capital is diversifying. Traders are starting to price in chronic instability in U.S. fiscal and trade policy. And when volatility becomes structural, yield alone can't hold capital. Investors begin seeking systems, not spikes, ecosystems that feel stable and self-sustaining, which makes China's next move even more provocative. According to Bloomberg, Beijing is considering expanding its southbound Bond Connect program, a policy that could allow up to 1 trillion yuan, or about $140 billion, in outbound capital flows. That means Chinese institutional investors could soon buy foreign debt, from Eurobonds to U.S. corporate paper, with far fewer restrictions. On the surface, that might sound dollar-friendly. In practice, it's a step toward Wall Street displacement. The People's Bank of China describes it as building reciprocal flow, a mature financial ecosystem centered in Hong Kong, designed to attract inbound global capital while granting outbound access to Chinese institutions. The endgame? A self-sustaining financial hub that operates without Wall Street and eventually competes against it. With the Hong Kong Stock Exchange preparing to list multiple sovereign BRICS bonds, that vision is inching closer to reality. Meanwhile, U.S. fiscal policy is feeding the fire. The latest tax bill added $3.4 trillion to the deficit, according to the Congressional Budget Office. Inflation projections for 2026 have already jumped 1.7 percentage points. But the deeper issue isn't just economic, it's political. The Joint Committee on Taxation reports that the top 20% of earners will see a 2.3% income gain, while the bottom 20% will lose 2.3% in real purchasing power. Add tariff-driven price hikes to that equation, and the economic strain becomes severe. When the middle class can't spend, growth stalls, retail contracts, and small business investment freezes. It's a replay of 1970s-style stagflation, only this time, the competition is global. The Peterson Institute for International Economics warns that if August tariffs take effect, inflation could spike between 15 and 20%, putting unbearable pressure on American households. Contrast that with BRICS economies, which are easing credit, cutting rates, and subsidizing trade. The contradiction couldn't be sharper. The U.S. tightens while BRICS accommodates. And perhaps the most sobering realization, this entire global realignment was built using America's own playbook. Trade corridors, digital payment systems, reserve frameworks, supply chain logistics, all born from U.S.-backed globalization. This isn't a coup, it's a remix. The very tools once designed to expand American influence are now being used to balance, even challenge it. And if Washington keeps threatening instead of competing, it won't be tariffs that isolate the U.S. It'll be gravity. So the question stands, will BRICS back down? Will Washington recalibrate? Or are we watching the final fracture of the old trade world unfold in real time? Let us know what you think in the comments. And if you're enjoying this breakdown, don't forget to like and subscribe for more global analysis just like this.